Good afternoon, ladies and gentlemen, and welcome to the Good Energy Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. And before we begin, I would just like to submit the following poll, and if you'd give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the executive management team from Good Energy Group PLC. Nigel, good afternoon, sir.
Good afternoon, Jake. Thank you very much. And very good afternoon to everybody who's joined the call today. As usual, I'm joined by Rupert Sanderson, Good Energy's Chief Financial Officer. And to give you a sense for what we'll take you through and the length you should expect it to run for, after a few opening words from me, I'll hand over to Rupert to walk through our preliminary results for 2023. Then I will update you on the progress in terms of our strategy, both in terms of what we saw last year and what we're expected to do this year, and that should leave some time for questions at the end of the meeting. And I think if I want to get one message across today, it is that 2023 was a year of transformation, really, for Good Energy, and the business is now a very different one from the one it was, say, 2 or 3 years ago, and really cemented by the last year. And I say that on 3 fronts, really. The first is that it is a year where we have posted a very strong financial performance. So our profit is ahead of market expectations. Our balance sheet remains strong, and that is despite a significant amount of investment in the future of the business through the year. So we've had a strong year financially. Perhaps equally importantly, or more importantly, we have also shown that we can really accelerate with our strategy of becoming an energy services provider. And we've seen that on 2 areas, really. First is, for the first time, we have seen a series of new tariffs, services, particularly for our core microgenerator market, be launched and reach significant scale. And that is gratifying to see. And secondly, through the 3 acquisitions we've made just over the last 12 months, we have developed a considerable now footprint for heat pump and particularly solar and storage installation across the south of England, which we think gives us a fantastic opportunity both to deliver on Good Energy's founding vision, really, around decentralizing people's energy usage and putting an element of the fight against climate change into their own hands, but also in achieving significant returns for our shareholders in the future. So each of these themes we'll explore in a bit more detail as we go through today, but I'm going to hand over to Rupert now to take you through the financial performance.
Thank you, Nigel. So let me just summarise the sort of key financial headlines of the year. So starting with the P&L account, the key message here, as Nigel outlined, is the very strong growth in operating profits year on year. And there are a couple of points at play here. The first starting at the top of the P&L, the revenue line is actually substantially unchanged over the course of the year. Reflects the very steep growth in commodity prices in the second half of 2022, and then an equally steep decline in commodity prices as we have gone through the year of 2023. In 2024, we'll actually see the decline in revenue continue, because commodity prices are now under half where they were probably 12 to 18 months ago, and that reflects the fall in commodity costs. So revenues will follow that in 2024. We're already seeing some of our business contracts repricing, and we've announced a very significant reduction in our standard variable tariff for domestic consumers effective the 1st of April. But the main driver of the performance in 2023 was the impact of hedging a number of the commodity costs in that very high price environment well ahead of time. So we had, and for those of you who were on the call in September, we talked about the benefits we got from hedging the Q1 power and gas much earlier in 2022. So we had a benefit of that in the first half of the year, and that has followed through to the full year. So we see a very strong increase in gross profit year on year. We have, though, continued to invest, and we'll touch on some of the acquisitions we've made. So our operating costs have gone up. Approximately half of that relates to the resources and the other costs we actually have within our installation services businesses now that we didn't have a year ago. And then half relates to some of the costs within the energy business around debt provisioning and around some of the regulatory costs that, again, we saw in the first half of 2023. But the key driver here is that operating profit line, which has really bolstered the whole of the 2023 year in terms of year-on-year performance. If I flick on, please, Nigel. And we can just see that in this outline, and we go through this graph in most of these presentations because it tells a little bit of the story of some of the major movements. Obviously, we report our profit before tax, and that included last year a very significant revaluation gain from the Zap-Map fundraising that we completed in 2022. So our reported profits in 2022 were actually higher than our reported profits in 2023, although about 80 to 85% of that related to that one-off accounting gain. So 2022's underlying profit performance was only a little over £1 million, and that's what we're really comparing in terms of the performance in 2023, which is much closer to £6 million on a profit before tax basis. And the two or three main drivers in that, and we've touched on some of those already. So volume reductions, this is principally as a result of customers reducing their consumption in a high price environment and in a energy saving environment. And then some planned reductions in some of our commercial portfolio, where we continue to focus on the sectors and segments that most closely align with our strategy going forward. And then we see the very significant profit driver, which is the phasing from this extraordinary commodity and pricing cycle that we've seen over the course of the last 18 to 24 months, which is now unwound as we go into 2024. And as Nigel said, that £5.7 million worth of profit that we have reported in 2023 is ahead of the guidance we issued in November of 2023. And if I just go on to cash. So the cash performance, again, has been very strong. We've had 2 or 3 years now where our collections experience on our customer debt has been very, very strong, and this has continued in 2023. Our operating cash flow is almost double our profit before tax, so which is quite unusual in itself. There's a couple of items within that. Obviously, we have converted our profitability into cash through those strong collections. We also have the loss from the Zap-Map business, which is a non-cash item. And we've successfully released over £2.5 million of cash that was tied up in security deposits lodged during the energy crisis. And so that is now available for us to use. So £5.7 million worth of profit, but we've generated operating cash flows of £12 million. Very pleasing result. Working capital movement is a favourable £8.8 million, but I will call this out specifically. This almost wholly relates to an increase in customer credit balances during the course of the year. The industry as a whole has seen this characteristic. It's a combination of the rapidly falling tariffs in 2023 and customers reducing their consumption. And we're taking very active steps now. We've both released functionality on the app for customers to self-serve and request that credit back. And we are taking a much more proactive stance of contacting customers and paying them back even when they haven't requested in order to get that into a more normal state, because it has risen quite sharply over the course of the year. And we expect it to reduce quite sharply during the first half of this year. We've continued to invest in growth, so we've now made 3 acquisitions over the course of the last 16 to 17 months. And in 2023, we completed the acquisition of Wessex Eco, and that was an initial investment of £2.5 million. And we've continued to invest in the resources and growth of both heat and solar businesses during the course of 2023. So just in summary, in terms of our overall cash position, our cash and cash equivalents on a reported basis have risen by over 16 million pounds over the course of the year to 41 million pounds, notwithstanding that increase in credit balances I touched on. We, in addition, have just under 6 million pounds of security deposits, so we do still need to lodge some funds with trading counterparties, some funds with industry participants, and we still hold a small amount of funds on behalf of the government support schemes, which either needs to be finally distributed to consumers or returned to the government as the reconciliations over that usage over those periods concludes over the course of the next couple of months. And then I've got one final summary, which I think is just in terms of sort of overall financial standing of the company. The business remains very well capitalized, is substantially debt-free, and available cash of more than 20 million pounds when you look at the credit balances and the remaining bond debt we have. We have invested at the start of 2024, and we purchased JPS Renewables. A number of you will have seen that announcement, expanding our energy services footprint across the south of England. We funded that with a mixture of cash and a vendor placing, which is really a sort of combination of retaining cash for future growth, because not all of that 20 million is available to use. We need working capital and risk capital within the business, but also the vendor placing to increase the overall liquidity in our stock, alongside an accretive transaction. So that was the balance of cash and equity that we used for the JPS transaction. As we go through some of these meetings in 2024, we're also going to start to talk about the business in a different way in terms of this financial segmentation. Having bought the three installation services businesses, they're obviously increasing in scale. They have got growth potential in revenues and profits, and we're going to change the way that we report our business externally, internally into investors. So we are going to split out the energy supply, import and export activities and report that as one segment, and then the second segment will be around the installation businesses and our feed-in tariff administration business. So it should be much clearer in terms of the growth and the change of our business as we move increasingly towards a services-led business. Finally, on the back of the very strong performance in 2023, we have proposed a final dividend of 2.25 pence, which, in addition to the interim dividend which we paid of 1 pence back in the autumn, would make a full year dividend of 3.25 pence. So an increase in return to shareholders over the course of the previous year in terms of dividend payments of a little under 20%. And at that, I will hand back to Nigel.
Thank you, Rupert. So we're going to now just look into the company's strategy and try and gauge our progress during the year. Just as a reminder, 2 years ago, we sold our generating assets. We sold them because they supplied a minority of the power that we supplied, and because selling them would give us a much stronger balance sheet and give us capital to invest in the future growth of the company. And we have begun to do that in anger over the last couple of years in trying to build an energy services proposition that sits alongside our commitment to renewable supply and working with renewable generators, will enable us to help far more people into the future decentralize their energy generation, use new green technologies, and we think helps us build a business that both delivers on our mission, but also helps build a strong and reliable return for our investors. So let's take the macro view first, if you like. A few slides, 3 slides on this. The message I have here is less the data, which we'll come on to a minute, but more actually just to reflect that the nature of energy supply and energy consumption in the UK is going to change quite radically over the next 5 to 10 years. And it is going to change because both high energy costs, consumer demand, and either policy or consumer interest in greening our energy grid and our consumption of energy will be a strong driver of it. And we're moving towards a world where a lot more people will have solar and storage because it'll be easy for them to install and run their energy that way. And a lot more people will have air source heat pumps because that is the only credible replacement for gas boilers if we're going to get anywhere near our net zero targets. And you certainly see that reflected in the expectations of marketplace growth, which is one of the reasons why we have invested behind solar storage and heat. The solar market is more developed in the UK. It's worth about £1.9 billion in the year we're talking about. That marks considerable growth on 2022. And that is really because high energy costs and consumer interest in this has driven it to that place, along, frankly, with the fact that it is a much better product now than it was, say, 10 to 15 years ago. It's more controllable, easier to use. We're anticipating that growth continues. So if we are to get anywhere near our government climate goals, we need a significant increase on the approximately 8% of UK households, eligible households who have solar panels at the moment. And that's likely to fuel market growth at least 10% a year to take it to about a £4.6 billion market by the end of the decade. So substantial structural growth in terms of solar power and storage. And heat pumps are also, we think, a growth market. There was a lot of press about this particular heating technology, perhaps a surprising amount. First thing to stress is that there has been growth in heat pump installation in the last year, growing by about 20% to about 35,000 installations. That is despite significant amounts of misinformation about the performance of heat pumps and a significant campaign from certainly people with vested interests in boilers and heating and gas pipelines to persuade the country to stay on other technologies. But there is evidence of underlying consumer demand. I think the government's subsidy package is helping, so they've moved up to £7,500 from £5,000 in the autumn. And so we have seen some demand. However, this has to move considerably if we are to get anywhere near national targets for air source heat pump installations, which sit at around the 600,000 level. So we're expecting more stimulus, hopefully a clearer planning regime, more promotion, drive growth there. So again, it's another structural growth market that we are investing behind. So if that's an economist's view of it, sort of, what does it look like for the consumer? We touched on this before, but it was worth reiterating. Here is our home of the future, if you like, and how we play with it. So electric vehicles are often the first port of call for people adopting green technologies. There are about 1.4 million electric vehicles and hybrids on the road in the UK now. We're obviously very significant players in the EV market, either through Zap-Map, which I'll touch on later, or through offering an increasing amount of specialist tariffs for EV drivers. The next quarter we'll be launching further EV tariffs with Zap-Map bundled in them, for example. We're also interested in the EV market because once people have EVs, they're much more likely to want to install solar panels for the obvious reason that their electricity consumption has increased significantly. And in fact, Zap-Map's own survey data would suggest that they are 7 times more likely to want to install solar. So Zap-Map gives us a pool of people to market to. They're in the relevant area of the country where we can do that installation. We obviously have services to both install solar, but also to give you the wherewithal to run that installation efficiently, to get paid for any exports we're doing. And we anticipate developing further behind that. If people are making the energy transition with their homes, then heating is the other category. That's why we've chosen to to acquire and develop a heat pump installation business. We'll talk a bit later about where in the market that is focused. We have a very capable heat pump installation business, which does full service jobs. So it will also make alterations to a domestic heating system if that is required. And we monitor those heat pumps after they've gone in, and we're very confident. We actually have a university working with us on this. It's been shown that we have about a 4-fold increase in energy efficiency over gas boilers for our heat pump customers. And then lastly, and this is where the supply business may well become more relevant again, increasingly we're going to want to consume electricity in a more flexible way, especially when our homes are entirely electrically driven. And that will mean being able to deliver flexibility, being able to offer people cheaper electricity in off-peak parts of the day, make intelligent choices around when you're generating power, when you're exporting power, when you're storing power. And we have some nascent investments in this area, capability to do more, and we'll be doing more over the course of the next winter and beyond. So Good Energy is well positioned for the emerging nature of the energy market in the UK. And I'll just stress that point, maybe having talked about the economic point of view and the customer's point of view from the business's point of view. We are investing to deliver a good energy branded proposition really across the run of services here. So we can supply, and absolutely very proud of our supply of genuinely renewable power with very high quality service behind it. We can increasingly install new technologies and give people the tools and the wherewithal to keep running. And that is vital service, I think, for people who want to make the energy transition. There's also an important service thinking about our business and our ability not just to be paid for one-off fees for those installation jobs, which is the bottom line there, but actually also because it enables us to tap into further and recurring streams of revenue as we, for example, buy export power from solar generators who install panels, or we work with people with batteries to develop flexible solutions, or we offer maintenance packages for heat pumps once we've installed them. So over time, you will see Good Energy having deeper and longer lasting relationships with its customers. They're already pretty sticky compared with many energy supply businesses, frankly, because of the suite of products we offer. And we've got some early data to suggest this is the case. So in the solar installation work we've been doing, about 20% of the people we install for take supply and export services from us, and about 14% of the heat pump customers we've served this year have taken supply from us. So some early indications that we can make cross-selling. I'm going to take each of those areas of the business in turn. Let's start with the supply business. It's worth reminding ourselves actually that the UK's energy supply market has reconsolidated. So we had a big six at the start of the last decade. That was deemed to be problematic, or deemed to be sleepy incumbents offering high prices and poor service. And so much reform was pushed through to further increase competition into that marketplace. As you will all know, and some of you may well have been customers of some of these suppliers, in the end, the energy crisis rather did for that approach, and we've ended up with a big six again. We're not part of that, but it does mean that we have to maintain a very differentiated position if our business is going to flourish, and that, I think, is what we are achieving in the supply market. We are still one of only 3 suppliers derogated from Ofgem's price cap regime because of the level of commitment we have to the UK's renewable generators, in our case, obviously, in terms of working with smaller scale and decentralised generation and bringing them into the energy grid. So how do we know it's been a reasonably successful year? Well, we remain recognised by very authoritative bodies as one of the greenest, if not the greenest, energy supplier in the country, which the Consumers Association for 3 years running, for example, has placed us as the top eco provider in its league table, and our tariffs are regularly called out as the gold standard or green by the likes of use, which you've got on the screen there, for good housekeeping. So our sourcing and our proposition remains strong. It is underpinned by high service standards, and we use Trustpilot as our main tool of measurement for that. And I'm happy to say, and very grateful for the team working on this, to say that only we and one other supplier, to my knowledge, are rated as 5-star operators on Trustpilot by our customers. That is not an accident, and is the result of significant investments in systems, adopting Kraken from Octopus Energy initially, and in training of our people. And I'm very grateful for the effort that goes in to serving our customers as well as we can. So we have a differentiated proposition, we have differentiated service standards, and we're extending that into the business market as well. So one of the bones of contention, and we've certainly raised it a few times, is the nature of green tariff labelling and whether buying certificates in the marketplace means somebody can call themselves green. We don't think that's a strong enough signal. We much prefer to suggest that people should be able to show over time how much they can match against renewables. And we are actually the first supplier in the business market to be able to offer business customers an hourly matching solution where they can measure what proportion of their energy supply in a given hour is coming from renewables. It's a standard that got a lot of interest at the last COP, and people like Google are interested in adopting, and I'm very proud to say that Good Energy is the first supplier in the UK business market, enabling customers to look at us in this way. So we continue to maintain a a strong and differentiated supply business. Well, we've added to this, and the first place we've added to this is in solar panel installation. Usually these days, solar and storage, about 80% of the jobs we do have a battery in them as well. And one of the questions I'm occasionally asked is, well, isn't this actually a very difficult market to compete in? Isn't it full of very low barriers to entry, and one where a lot of single operators can buy equipment and start to do domestic jobs? And that is the case. And it's also the case that some of the larger suppliers are trying to scale up their own propositions in this marketplace. And in keeping with our supply proposition, the two businesses we've bought, which are shown on that scatter plot there, are working on higher average system sizes, so bigger roofs, often more complex jobs, and therefore more expensive jobs. And that is a very deliberate positioning on our part. We are targeting a high service, high quality installation rate. We don't use agency labour, for example. We try to even take control of our scaffolding when we can do on these jobs. And that is reflected in the very strong trusted trader type ratings these businesses get, 5 stars with them, and reflected in the fact we're running what we think is a differentiated proposition, much more in keeping with our supply heritage, and one that can therefore maintain a margin of about 30% of the gross profit level when others may be below that because they're chasing high volume. We're not doing that. We are a specialist, and the firms that we've bought and are beginning to come under the Good Energy umbrella are specialists, and we're very pleased with the work that they do. The same point applies in the heat pump market, albeit with slightly less data. Solar panel installation market, as an aside, is very well served with market data, so it's very easy to figure out where you are. But the heat business we have is similarly focused on larger and higher quality jobs. It's a full service offering, so we change on average 4 radiators, for example, in each of the installs we do to make them bigger and work better with heat pumps. Our warranty levels are very high. Our monitoring is constant after the heat pump goes in, which is why we can stand behind the 4 times the efficiency of the gas boiler rating that we've got there, called out there. And we're tending to do slightly larger systems, slightly larger jobs than the industry margin, which again means that we aspire to maintain a margin of the order of 30%. It's got up to about 28% at the end of last year. And again, we aspire to serve a target market which is very similar in nature to Good Energy's supply heritage. So those are the installation businesses and where they're positioned and what they're doing. The other thing we do in the heritage we have, of course, is providing services to people who have this equipment installed. The feed-in tariff scheme was something that Good Energy played a very large part in creating in the first place, for example. And last year was a very important year for innovating for those customers and launching new products. So for the fit market, we launched what we call Smart Export. That uses smart meter data to pay people on their actual export volumes, not on an assumed amount, which for most fit customers means an increase in their payments. It's also a unique proposition in that marketplace, and one in which I would hope to take market share from here now that it has launched and scaled. For the non-fit customers, for the people who have come onto solar in more recent years, our solar savings products offer industry-leading rates for exporters. We're paying at the moment 15 pence up to 20 pence a kilowatt hour if somebody installs with us for those customers as well. So we're making waves in the microgeneration market in that way. And we have, like a number of suppliers, put a foot into the waters of demand flexibility. Our Power Pause product was taken up by several thousand customers over the winter who have been reducing their consumption at the points in which National Grid offer an incentive to do so. That won't change the world economically this year, but it does give us a sense that for a segment of our audience, there is an interest in flexibility, which we will go on to develop further. Smart meters are the enabling technology behind this, and our smart meter count is now sitting at 46,000 meters. They were reasonably recently installed, so most of them are SMEX 2, some more performance meters, and we continue to try and build on that number. So where do we go this year? What should customers and shareholders expect to see us doing next? Well, quietly over the last year, we have made considerable improvements to our digital products and services. So we're now a much easier business to engage with on our app, for example. And one of the things Rupert referenced there, which is paying back customers whose credit balances got too high, you can now go onto the app and request a credit balance and self-serve in that area. So we've got some further improvements to our operational efficiency there. We certainly don't object to customers calling us. We have a very good service on the phone, but for many people it's more convenient not to. They prefer to deal by email or through an app, and we are developing further to make sure people can get the services they need. I'd expect further innovation on the tariff side after a couple of years, frankly, of being largely frozen. The supply market is seeing a bit more movement and development of new tariffs, and we'll be focusing on tariffs for electric vehicle drivers and microgenerators as we go into this quarter. And we'll further be building out our propositions for heat pump owners, offering maintenance and servicing plans for those customers. And then in the background, because it's unlikely to be very visible for some of this year, we are continuing to invest behind the flexible future. And that means beginning to be able to adopt elective half-hourly settlement, to use the jargon, but basically that means allow domestic customers to work in the way that business customers have traditionally worked, where, because energy is priced, bought and sold on the market on a half-hourly basis, you're aligning their billing and consumption with that, so they can begin to take advantage of periods of cheaper power, more so when they've got their own battery or cars to store the power in, or their own generation. And that's an important part of our future. So we have, I think, shown ourselves to have a good track record and a good pipeline of innovation in terms of the services and tariffs we provide people who have installed green technologies. Selling this is important. It's funny to talk about this, really, because for a couple of years, many energy companies haven't had much to say publicly, and most of their dialogue with their customers has been around the market crisis or government support schemes. We are making fast strides to make sure we can sell and market our new propositions. And part of that means bringing all of the businesses we have acquired recently under the Good Energy brand, something that the management team support entirely, by the way. So over the course of the first half of this year, everything we do will be branded clearly as Good Energy. And if you live in some parts of the country where we have teams who could do the installation work as well as we can reach with supply and export services, you will see an increasing amount of advertising, be it out of home, radio, direct mail, targeted digital advertising. See some examples of it there, all of which are aimed at cementing the fact that we have both a deep green proposition, but also an energy services proposition to help people make the energy transition. And the last side of that transition, one we have been investing in for a while, is of course the greening of transportation. And for us, that predominantly comes to our investment in Zap-Map, where we are the 49% holder of their shares at the moment. I thought I'd bring a couple of thoughts on Zap-Map to our investors here. First is actually how they think of themselves and how I think of the business, which is increasingly Zap-Map is a data. It takes data, some of which is public, most of which is hard to find and very difficult to build, from either charge points or from drivers or from users themselves. And in the Zap-Map then cleans and verifies that data and then builds products on the back end. And it builds three areas of products. It's built and improved its own app for Zap-Map for electric vehicle drivers. We'll touch on the data on that in a minute, but it remains the best way to plan and pay for your charging in the UK market. Zap-Map Spark is an API, it's a feed of that data, which we can license to other people to build their own digital products. So FleetCore, the fuel card company, use it to power their electric vehicle fleet services. And we have signed agreements, or about to sign agreements with parking operators and other commercial fleet operators to do likewise. And then finally, Zap-Map Insights is actually the sale of data generated by the app back to the electric vehicle marketplace. Excuse me 1 second. And the reason we're investing, a reminder at the bottom, the EV market is very much at its start. As they replace the internal combustion engine cars, ICE cars as they're called, we should expect significant numbers of electric vehicles, charge points. That is all a market for Zap-Map to play into. All the more so that it has, in the course of the last year, launched its mapping internationally. So you can now drive from London to Lyon as much as you could from London to Leeds using Zap-Map to plan your journey. So a bit of an insight into how that business is going. Some of the numbers are on the right-hand side there. So there are about 1.6 million, I think I said 1.4, drivers of some form of battery-powered car on the roads in the UK. Zap-Map has been downloaded 1.4 million times. And as you can see there, I won't read them out, very significant proportions of particularly the battery electric vehicle park are registered users and monthly users of Zap-Map. A couple of things I would call out. They've done a lot of work during the course of this year to improve the usability and functionality within their app. So I think as a search tool, it's working very well now. As a payment tool, we reach about 25% of the public charge points in the UK. So they continue to develop Zap-Map very well indeed. And as we've said before, we're in the midst of a fundraising round for Zap-Map Series B, which I expect to update investors on during the course of the next quarter. By way of concluding, and those who've been following us for a while may remember, one of the ways in which we signalled our change of strategy and our change of direction a couple of years ago was to talk about a target we had in mind, which is to say that we were hoping to help 1 million people, 1 million homes and businesses cut carbon from their energy and transport use by 2025. And we absolutely included Zap-Map in that. We wanted to really talk about the fact that Zap-Map is an important part of our story. And I'm happy to say that both the stability in our supply business, additional customers for installation, and Zap-Map's growth means that we've hit that target a year early. Good Energy is now touching more people than ever before in terms of delivering on its mission to combat climate change. And with that, Jake, I'll hand back to you.
Perfect. That's great. Nigel, Rupert, thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the company takes a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Rupert, Nigel, as you can see, we obviously received a number of pre-submitted questions ahead of today's event, and in the Q&A tab, we've also received a number of questions throughout your presentation this afternoon as well. So firstly, thank you to all of those on the call for taking the time to submit their questions. And Nigel, Rupert, if I may just hand back to you to read out those questions and give your responses where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Thank you, Jake. So I think what we'll do is I will act as question summariser and read them out, or at least summarize them if they're quite long, and then either I'll answer them myself or I'll hand over to Rupert to answer them. I'm conscious that people on the call maybe can't see the questions, so we will sort of give the detail of them quite clearly. So the first one, which is pre-submitted, is to ask for the reason for the jump in return on capital employed to over 20% for 2022 and 47% TTM, when it was in single digits prior to that. Is this the new normal, and if so, how will it remain sustainable? So really a question on our return on assets.
Yep.
Return on capital employed. Rupert, do you want to take that?
So thank you for the question. The shape of the capital structure of the business has changed quite substantially over the course of the last couple of years, and that's really the fundamental reason for the change in this returns profile. So having sold the generation assets in early 2022, we have become a substantially asset-light business in terms of the return profile we will get. And we're increasingly investing into services businesses, installation businesses, which don't require an awful lot of capital apart from the upfront investment that we are making into them, or as they grow, just in terms of the development of the and rollout of those services. So I think it is the new normal, and I think that it should be sustainable in terms of us being able to operate those services businesses on a profitable basis and without recourse to a substantial amount of incremental capital.
Thank you. Yeah, I'm going to emphasise the point that, I'm glad you've noticed almost, and because that is a sign that our strategy has been able to deliver, and that was the intention behind it. So there are two questions now which are pretty close to each other, so I shall summarise them both, and they're both about Ripple Energy, a business we know well. For the people who aren't aware, Ripple are effectively crowdsourcing for the construction of initially wind and now solar assets, and then they have a proposition where with one or two suppliers you can effectively see discounts off your bill for the productivity of the asset you chipped in to build from it. And the questions basically are we interested in incorporating Ripple into our own offering. And I think there's two answers. This is actually, first off, yes, we're very aware of Ripple, very supportive of what Sarah and her team are doing, and it's certainly something we are considering. I think since we also serve green-minded consumers, there's a natural fit there. The one note of caution I would have is that we are actually, of course, doing slightly different things. Ripple are building new generation assets. We are trying to help people decentralize their energy consumption entirely and do more of it themselves. So there's a slight, not competition, but there is a difference in proposition there. Ripple is in our product backlog. Other ideas which are particularly focused on microgenerators have rather trumped it so far, but we will continue to look at Ripple, and when there's a space, look at putting it live. So that deals with a couple of questions on Ripple here. We've then got a question from somebody, which is, I'll read out a bit of, but somebody who's a long-term customer and investor who invested and presumably took on supply, understanding that there was a higher unit charge for green energy to ensure our suppliers, who are often small, get a fair return over the long term. But then I think asking about both the impact of COVID and the energy crisis on these on the renewable markets, the customer is saying that they expected not to pay at previous rates, to pay at a discount to market rates, as our suppliers were on long-term contracts, which would have been set lower than the markets. In fact, sometimes we've been when our rates are above the market. It's not clear in your supply chain who in the supply chain benefited from the windfall. So, Rupert, can we comment on suppliers, the energy crisis, who's really benefited, and what are we doing in terms of pricing?
Yeah, so I mean, it's a good question. There's quite a lot of detail within it. As you say, we are contracting with around about 2,000 small independent generators across the UK in ways that not many other participants would, and we are offering them typically a 12-month fixed price contract for that renewable generation, and that does come with an extra cost, and it comes with extra risk to us, and therefore over the medium term it has been the case that we are probably more expensive than other suppliers who will buy that power on the traded markets and not have to participate in that level of complexity. But contracting at different times of the year also has advantages. So as Nigel says, there have been periods of time where we're able to pass on the benefit associated with buying that power in a lower price environment through to our consumers, customers as well, in terms of lower prices than they would otherwise be able to get on the market. There have been quite significant swings over a decade-long period in terms of market power prices. So there have been periods very low as well as periods very high. I would say that over the course of the energy crisis as a whole, the major beneficiaries of the very high commodity price environment have been fossil fuel producers and some of the very largest electricity generation companies or assets. And market prices are effectively linked to those assets, and therefore it's only in an environment where there's a wholesale market reform, where there's a complete decoupling between renewable generation and fossil fuel generation that we would see the sort of position which I think you are advocating. It's one that we've lobbied quite strongly for. It isn't something which is looking likely, unfortunately, to happen in the very short term, but it's something we will continue to press for.
Yeah, thank you. The next question is on heat pumps, and it's more about the heat pump market, but then relates to us. So I'm aware that the UK has a relatively low uptake of heat pump, touched on the presentation, compared with other European countries, partly due to the UK average electricity to gas price ratio being so unfavourable. I'm quoting data which I recognise as well, but it being 4.4 electricity to gas compared with, say, Denmark at 2.6. Can I advise what the good energy average domestic customer electricity to gas price ratio is currently? So this is an interesting industry anomaly, which is one of the barriers to wider heat pump adoption, which is really driven on two things. One, electricity in the UK is, on the wholesale market, expensive because we depend on gas to generate it. And secondly, electricity is where we tend to put a lot of industry levies and social levies, because electricity provision is universal, whereas gas has a large number of households who aren't on the gas grid, and that produces this comparative disparity. 2 points in answer to this. First, actually, at the moment, and certainly for a lot of last year, we are below the price cap level for electricity only. So our electricity is slightly cheaper. Our gas, because it's got a green gas element to it and an offset element to it, is slightly more expensive. So if you look at the performance of our heat pumps, which are 4 times more efficient than gas boilers, and if you look at our price disparity, we are at least in a place where we can say to customers, adopting a heat pump and using Good Energy as your supplier will leave you better off, all other things being equal. But that gap's there. We're doing our bit, and we generally, in pricing terms, want to reflect the fact that we think electricity is the cleaner fuel, that more, and certainly a fuel we sell a lot more of. But there's more to do, I think, in terms of structural reform again. So another question here, which I'll answer at a very high level and then hand over to Rupert. So with such a strong cash balance, which you heard about there, why did you sell shares for your most recent acquisition? So the bit in a minute I'll ask Rupert to answer is just to point out that whilst we have high cash numbers, not all of that cash is usable for us for future investments. The bit I would add on that is the other reason we did the vendor placing, which is not a huge transaction, about £2.1 million worth of shares placed, plus further shares to the people we bought the business from, was that one of the things that's held Good Energy back in share price terms over the last years is a real lack of liquidity in our shares. They're tightly held, and they're tightly held by relatively few institutions. So diversifying the shareholder base a bit, introducing some more liquidity into the shares, was, the board felt, a good thing for all investors, and by and large that's been the case since the placing was done. But we have a lot of cash, Rupert. We can't use it.
We do, and I think I touched on it in the earlier presentation in terms of the cash balance we have. As I indicated, there is at the balance sheet date, there is a higher proportion of that is customer credit balances than we would expect there to be, and so that will have a natural reduction as we go through 2024. And then I think in previous presentations we've talked about the need for working capital to cope with both seasonality within the supply business and a rising and falling price environment, and the difference in terms of the timings between paying for that commodity and receiving payment from customers, as well as the experience we've seen over the course of the last couple of years in terms of the volatility in the market, and an element of risk capital that it would be prudent for any business to hold, having seen that sort of market characteristic and be prepared for it in the future. So as Nigel said, we felt that we were able to invest cash behind that transaction and others, and Nigel's highlighted why there was a mix of both cash and equity in that case.
Thank you, Rupert. Next question on remuneration, which is to ask what our salaries are and do we receive bonuses. So I'll answer that in 2 parts. Our salaries, in fact, the details of all of our remuneration will be published in our annual report, which comes out at the time of our AGM in June, which will be the time which we can sort of...
A bit earlier than that, end of April.
End of April, sorry. Yes, the AGM is a bit later, but the annual report comes out end of April. So you'll be able to read all of the detail there. We do receive bonuses. Our bonuses are judged on the same basis as everybody working in the supply and services side of the business. The installation services businesses have their own bonus targets. We are remunerated on our bonuses are based on a combination of the company's financial performance and performance on key strategic targets set by the board, which are usually around the levels of customer service, and this year the adoption of new services propositions. Have we completed all of the possible acquisitions in the southeast area, or are there more to come? So a couple of thoughts here. You're certainly right that the geographic fit was an important consideration for us, because as you try and grow these businesses, you can then get some growth by putting in new install teams who can be served from the existing infrastructure. So having owned a border business in Dorset, buying one in the southeast made a lot of sense. There's a sort of a bit of a natural pause here whilst we did the work on branding I was talking about. But we have a template here for the types of businesses we want to bring in, higher quality, working on sort of more complex, larger jobs, higher quality installations, with good fit with good energy, and we will continue to look at the market and see if there are more to come. There are no immediate plans. I just want to stress that we're not about to make an announcement in the next 2 months of another acquisition, but there are some other good players in the marketplace, and we'll look at them. I think if we succeed in really serving most of the south of England, it's probably more likely that we begin to look further north for the next additions. I certainly think JPS in particular gives us a really strong footprint across Kent into London and East Sussex. Wessex can cover Dorset. JPS actually have a director who's moved to Cornwall, so we've got Cornwall moving eastwards covered as well. So plenty of other high solar installation geographies to look after. Next question, which is very direct but very clear. Did you overpay for the acquisition of JPS? And Rick, how should we look at the transaction and what we know about comparatives?
So as we went through the research for a number of the solar acquisitions, we were very cognizant of the comparables in terms of some of the acquisitions. And both JPS and Wessex, we've completed on a multiple of 6 times their current level of profitability, which we think is a fair price given those market comparables. There was actually one externally announced transaction in the last couple of weeks, actually, which was Wix acquiring a very similar type of solar installation business, and they paid a slightly higher multiple of 7 times. So we believe we've bought a good quality asset, a good quality team at a fair price.
Good. Thank you, Rupert. Very clear. Question from Marco. Who do we think are our greatest competitors, and how are we distinguishing ourselves from them? Well, I think there's 2 or 3 categories of competition for us. In installation, we tend to measure ourselves against other sort of regional specialists, so people doing slightly more complicated and higher value jobs. They tend not to be that well known apart from in their local area, so there's competition there. It is actually quite a fragmented marketplace. There are a lot of small single operators who we would think that we were offering a higher quality, more complete service than. In the broader supply and services marketplace, whilst the energy market has seen a lot of consolidation, there are still some formidable competitors out there, particularly Octopus, who are very innovative on the technology side for the early adopter market. They're a nod relationship with us because obviously we are using their technology Kraken to underpin our business as well. I think where our differentiation from them and other players getting into this market comes from 2 or 3 key accounts. One of the places we have scale is in the feed-in tariff market. So we're the only people who've really innovated in that market for a long time. So we have a genuinely better and more distinctive offer for feed-in tariff customers. We are pretty clear that we're sourcing a very green power mix. So for business and domestic customers, for whom that is an important consideration, things like the Which accreditation give us an important stamp to show that we are greener than them. And for many of our customers, both in installation and supply, a high level of service is important to them, and we've invested behind training and technology to enable the Trustpilot results that we got there. So it's clearly a competitive marketplace. For a small player such as us, you have to be very clear that you've got a distinctive proposition and that you're delivering a high quality product, and that's what we aspire to do. So a question from David. Congratulations on the good energy work. A quick question, would you also provide services to commercial clients who've got an energy efficiency company focused on hospitality and looking for a partnership? So I think the best thing to do is drop one of us a note through this, and we can absolutely look at that. We do work in the commercial sector. We don't particularly supply sort of heavy industrial commercial users of power. We do electricity only in the commercial sector. It's more in keeping with the way we source power. But we already supply, for example, PwC's office network around the UK, several sort of high ethical retail and other brands, and so we'd be delighted to talk to you, David. So some contact details. If not, we'll chase up with you. So a pricing question, which is around standing charges, which are often contentious. And so why have our standing charges gone up? Well, if we're both gas and electricity from the 1st of April. If I give the overview, you're welcome to go into the detail if we think there's an appetite for it. But I mean, I think two things here. We need to look at pricing in the round. And while I am aware that standing charges are unpopular because people who want to try and cut costs by cutting their consumption, standing charges are stuck there, if you like. Good Energy's customer base tends to skew towards higher consuming, larger properties for whom the unit rate is a more important consideration than the standing charge. And our most recent round of pricing changes have been to try and cut the unit rates as much as we could. In fact, our standing charges were pretty cheap before that. We had the sort of opposite position. And so the rise is on the back of a very low level of standing charge at some point in the prior year. I'd expect this to begin to normalise from here as the market normalises. But Rupert, you add anything to that? I think that covers it. I think that's the reason why they were very low. We're aiming to be more competitive on unit rate. I acknowledge no one's ever happy on standing charges. It goes both ways. So I shall scroll up. Question from David. Congratulations on your team. Do you consider yourself as a future growth stock and income stock? Would you consider a share buyback rather than dividend payout? Wishing you every success. So Rupert touched on our. Thank you for the good wishes to start with. Rupert did touch on our capital allocation. I think we see ourselves as a growth stock. Yeah,
we see ourselves as a growth stock primarily, and we do pay a dividend. And I think, there are different shareholder groups within this company, and it's something that we have traditionally done is maintaining a level of dividend payout. The yield on it is obviously at a level where it certainly is classified as an income stock, and therefore I don't think it's going to be something that we would be looking to increase. But certainly the way we position ourselves at the moment as a growth stock, paying a modest dividend, is one that we will probably look at as our main route of continuing against.
Oh yes, I think that's the distribution route we're going to go for rather than buybacks. So a question about Zap-Map from Paul, which is, when do you think Zap-Map will become profitable, and how much more investment do we think will be required? Well, this is actually quite a fluid topic at the moment, Paul, because we're in market with their fundraise. The fundraise argument is almost, if we want to build a large international platform and really take advantage of those numbers that were in the presentation for EV rollout, it is going to take a meaningful amount of investment. Again, it's going to take a fundraise round of around 10 million to do that. We certainly wouldn't participate in the same scale as we have done before. So we've said to investors that we're looking to put a couple of million more into it because we're supportive investors. We like the return that we'll potentially get, and that has a good fit with our UK business. But if they go international, there'll be other people who are investing more heavily than us. If the fundraising environment isn't quite so much, then we will have to focus the business a bit more in the UK. But we will see where we get to in terms of the fundraise round in the next quarter. So that was Paul on Zap-Map. We've got Adam next on why offer hourly matching and not either 4-hour in line with blocks or half-hour in line with settlement. So the hourly matching products I talked about for the business market is actually how our business customers wanted to sort of use it, I suppose. And they, I guess, making a trade-off between the way the market works, half-hourly or 4-hourly, and what's sort of simplest for them to communicate. So they were looking for an hourly matching product, and that's therefore what we've given them. We can obviously review that, and as the market, particularly the domestic market, moves towards half-hourly settlement, maybe the different unit applies. But for now, it was what the market demand was for, so that's why I went for now. Jake, can I get a time check, because we will be running over if we're not careful.
Hi, yes, we are just coming up to 59 minutes. You have the room for as long as you need, and of course, if we do run out of time, we can give you back all of the questions immediately after the meeting for your review.
Should we take one or two more, maybe one more, and then we'll go from there. So some questions on Zap-Map. Do we cover the northeast of England? Not yet so much. Why don't we'll finish with, there is obviously a lot of shareholder and customer interest in the energy market. Just as they test the fire. So a question from Chris K. The press has been commenting on increasing retail customer not paying utility bills. Is this affecting your business and the concerns of the business about bad debt? So you're right, Chris. Across the industry, levels of bad debt after this period of very high cost is flagged for considerable concern. I think the industry overall has seen figure in the billions of increased in terms of bad debt provisioning from all suppliers over the last 2 years. In our case, partly because we're a specialist, we're focused on a consumer base who've actively chosen to take a differentiated product. Our bad debt position is actually same or no worse, in fact, slightly better than it was even a year ago. So we don't have too much in the way of concerns. Rupert, might just be worth touching on what's in the account so you can verify that.
Yeah, no, so I mean, we did talk about the fact that our bad debt charge had gone up year on year. That isn't as a result of any deterioration in collections. It's just the methodology associated with it. So we look at the collection rates during 2023 on debt that existed at the end of 2022, and that's in comparison to the similar period of collections during 2022. So although we said that revenue hadn't changed in terms of reported between 22 and 2023, it's actually the difference in revenues between 2022 and 2021 which has driven the bad debt charge up. So I can understand the question about collections still being very strong, but bad debt charge going up, and that is a function of the 21 year and against 22 as opposed to 22 against 23. So I am comfortable that our performance in collections across all the segments of our business have maintained at the level that we had forecast to see and are performing well, and I think are performing considerably better than some of the industry in terms of some of the increases that they have seen in some of the segments and changes in customer payment behaviour over the course of the last couple of years.
Good. Jake, we will have to leave it there because time has run out, but can I conclude perhaps by thanking all of the shareholders and customers who've joined the call. I hope you found it increased your understanding of Good Energy and its business, and we look forward to speaking to you again soon. Jake, I'll hand over to you to wrap up.
Perfect, Nigel, Rupert, that's great. And thank you very much indeed for addressing all of those questions that came in from investors. And of course, given the significant attendance on today's call, we will give you back all of the questions that were submitted today, as well as any further ones that do come through back immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the platform. But Nigel, Rupert, all that leaves is for me to thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Good Energy Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.